Imagine this. You wake up one day, check your investment portfolio, and see that your modest savings have grown into a small fortune.
I just bagged the elephant.
That's the beauty of investing in the stock market, and today, we are going to show you just how to get started. This video will be your one-stop guide to take action now. If you're here, it means you're ready to take control of your financial future. Your guide will include how to start investing in both ETFs and individual stocks to build your portfolio. ETFs are short for exchange-traded funds, which you can think of as a basket of stocks. They are the most popular strategy for individual investors, and especially beginners. Still, I highly suggest you listen to both, as individual stocks are what make up ETFs, and understanding them can empower you to make the best decisions. For your convenience, there will be timestamps for each actionable step in the video. I suggest you take notes. You will hear everything I wish I knew, and all you need to get started. Your time is valuable. Let's get straight into it. First things first, what exactly is the stock market? Think of it as a bustling marketplace, but instead of fruits and veggies, you're buying and selling pieces of companies. So, when you invest in Apple or Amazon, you're becoming a part owner. Cool, right? The stock market operates on the principle of supply and demand. When more people want to buy a stock, its price goes up. When more people want to sell, its price goes down. So why should you own stocks? Well, as companies grow and become more profitable, your share of that company becomes more valuable. Plus, some companies pay dividends, which are like interest payments to shareholders. Holding stocks can be a way to grow your money over time, rather than losing it to inflation. In the short term, it's like a constant tug of war, but in the long term, as long as you hold on to the right companies, you'll be sure to be on the winning side. Remember, investing in stocks is about buying ownership in companies you believe will succeed in the long run. Step number 1. Setting your goals.
Goal should be to buy wins.
To start investing, it's essential to know why you're doing it and what your financial goals are. Think of it like planning a road trip. You wouldn't start driving without knowing your destination, right? The same goes for investing. Define your goals, and you'll have a clear roadmap for your financial journey. Are you saving for retirement, just looking to build your wealth, for your children's education, or a house? Having clear goals helps you determine an investment strategy that is right for you. For instance, if you're looking to build your wealth and have a long time horizon, you are likely to be best off choosing to invest in more aggressive growth stocks. But if you need the money in 5 years for a down payment on a house, you might opt for safer, more stable investments such as dividend stocks and bonds. This goes hand in hand with how you are able to stomach volatility. Even the best and quote-unquote safe stocks can go down 30 or even 50% at times. It could take a year for the stock to recover, then another to shoot back up into new all-time highs. If you are to invest in stocks, you must be able to wait and handle downturns.
You once told me don't get emotional about stock, Gordon. Don't.
Now that you know your goal, you are ready for step number 2, deciding how much to invest. You should only invest money that you won't need for coming expenses or potential emergencies. This way you won't be pressured to sell when your stocks are down, and you can even be looking to buy more. It is also important to have realistic expectations. On average, the S&P 500 index, which tracks the 500 biggest companies in the United States, or what investors call the market, has returned between 7 to 10% each year. That being said, in some years it might be up 30% and in others down 20%. So, set out an amount you currently have that you are fine with letting invest and grow without spending for the coming years. After that, try to set aside a portion of your monthly income to keep building your portfolio. Aim for 10 to 20% of your paycheck if you can, to start, with the ultimate goal of reaching over 30%. Just ensure you have a solid emergency fund and can comfortably cover your living expenses. Remember, investing is a marathon, not a sprint. It's about steadily building wealth over time to achieve your financial dreams. Step number 3. Now that you understand your goal and how much you can invest, it's time to set aside a cash position. Cash in your portfolio is like keeping an umbrella handy. It allows you to stay dry and make the best of things when storms roll in. Importantly, you should always aim to keep between 2 to 10% in cash. So if you are investing $10,000, that's anywhere between $1,000 to $200. This way, if the market is to crash or even take little dips, you are prepared to take advantage of great opportunities. As Warren Buffett says, you want everything you buy to be as cheap as possible: groceries, gas, and especially stocks.
I think I read Warren Buffett say something like that. No.
By holding some cash, you can better handle the emotions of downturns and even look forward to dips with the mindset of buying more. So how do you decide what percentage to keep in cash? Consider these factors. In the future, will you have a stable income to invest, or is it uncertain? If uncertain, hold a higher percentage of cash. Next, market conditions. This depends on how many opportunities you see to utilize this cash. If stocks are trading at low valuations, which we'll talk about later, take advantage and buy. If you struggle to find companies at fair prices, keep some cash and wait. This is something I didn't realize when I started, as I was always eager to buy with every spare cent. Don't worry, you don't need to monitor and keep an exact percentage of cash. Just make sure to stay between the 2 to 10% and try to add more cash when the percentage gets too low. As a rule of thumb, just make sure you have enough cash so that you would be comfortable if the market dipped, say 10 or 15%. Of course, you don't want to hold too much cash as it will earn you nowhere near the 7 to 10% average returns of the market. Step number 4, structuring your portfolio.
Stocks, bonds, little bag of plutonium.
Now that you've set aside your cash position, it is time to choose how to structure the rest of your portfolio. Imagine you're at that market again, but this time, instead of buying from just one stall, you have fruits and veggies from multiple stalls. This way, if one stall's harvest isn't great, you still get plenty of good stuff from the others. This is the idea of diversification, especially important when getting started. By spreading your investments across different companies, sectors, and even asset types, you reduce your risk. If one investment doesn't perform well, others can do better and balance out your portfolio. The most popular strategy for most individual investors, and especially beginners, is holding ETFs, short for exchange-traded funds. An ETF is a basket that contains many individual stocks. A portfolio of 3 to 4 ETFs is a great way to diversify while keeping it simple. Popular ETF strategies include holding a mix of the S&P 500 to own the largest American companies, a global fund for international exposure, and then something like a growth stock ETF, dividend stock ETF, or domestic bond ETF. You might be wondering if you should even hold bonds, and if so, what percentage? In case you don't know, bonds are loans given to governments or companies in exchange for interest payments. Bond ETFs are great as they provide you diversification and you can buy or sell at any time. Here's a chart with the general rule for allocating stocks and bonds depending on your age. Feel free to pause and write the split for you. Remember, this is just a general rule, meaning you can choose to be more or less aggressive. Overall, it depends on how much stability you want in your portfolio, as bond prices are less sensitive, and your return is likely lower, but close to guaranteed. Investing is all about balancing the risk-reward potential to fit your needs. And keep in mind, you can always change your strategy as you learn and grow. Let's get back to the structure. For ETFs, each holding can be around 10 to 40% of your portfolio, with the exception of the S&P 500, which can be given a larger weighting, typically from 30 to 60%, as it represents the US market as a whole. You can also hold an ETF in a sector or country you believe will perform well, like technology, energy, India, or AI. These can be given smaller 5 to 15% allocations if you choose to include them. Now, here are some simple charts to get an idea of popular portfolio structures. A 3-fund portfolio with 60% in the S&P 500, 20% in an international ETF, and 20% in a US bond ETF. Being on the aggressive side, it's best for those 30 and under. Here's a 3-fund portfolio with a 50 to 50 split of stocks and bonds. This portfolio could work in your 40s to 70s, although you can always hold a little more in stocks if you are comfortable. We'll go over exactly how to find the best ETFs for you soon.
Are those ETFs you asked for?
How about individual stocks? A rule of thumb, if you want to own only individual stocks, is holding 10 to 20. Of these, each holding can typically be around 5 to 10% of your portfolio. That way, even if you happen to be wrong about one company, again, the rest of the portfolio can help balance it out. It's just as important to diversify across multiple industries, and a great portfolio will have a mix of growth and value stocks. Growth stocks are companies that are expected to grow faster than the market, and value stocks are businesses that are undervalued or cheap. We'll talk more about value later. So which is best? Individual stocks or ETFs? This is step number 5, choosing what to hold in your portfolio. It will depend on you, your goals, and how much research you are willing to do. For beginner investors, ETFs are recommended, at least as you get started. To own an individual company, ideally, you want to understand as much as you can about the company so you can be confident and make the best decisions. For example, when the stock price falls significantly, do you buy more of the company, or is it a falling knife that you need to dive away from? Without extensive research, you probably won't know. Remember, the market likes to panic at times, and it can often be wrong. If you would rather keep it simple and only do minimal research, then ETFs are likely best for you. If you are willing to spend time understanding each company and are seeking potentially higher returns, individual stocks may be right for you, as you can pick specific stocks within the market you think will do better than the average. You can also hold both. A great strategy for beginners is holding 80 to 90% in ETFs and the rest to try out with individual stocks to see if they are right for you. Step number 6, finding and researching ETFs and stocks. Now that you've decided what you are looking for, here comes the best part, choosing what to buy. Picture yourself as a detective, digging for clues about a company or industry's future potential. Before investing your money, it's crucial to do your homework. We'll start with researching ETFs and then move to individual stocks. There are timestamps to skip ahead, although it is always great to learn both so you have the knowledge and options. For ETFs, you want to look for those with low expense ratios, strong track records, and broad diversification across sectors or geographic regions to align with your investment goals. Let's break that down. An expense ratio is the percentage of your investment in an ETF that you are charged fees on by its managers. A good rule of thumb is an expense ratio is lower than 0.5%. That means if you invest $10,000, you will pay a $50 fee. Don't worry, you don't actually need to pay a fee. It is automatically taken from the price of your investment each year. You can usually find the expense ratio with a quick Google search. If it doesn't come up, go to the ETF provider's website. The expense ratio is usually listed under the Fees and Expenses section. Even for the exact same type of fund such as the S&P 500, there are often many different companies that offer their own ETF version of it. A great way to get started is to search for articles on the best ETFs available in your country for each part of your portfolio. Let me know in the comments if you want a specific video on the best ETF portfolios. When considering an ETF for your portfolio, look at the top individual holdings or companies that make up the fund and their weightings. You can do so on sites such as Yahoo Finance. For example, currently, the S&P 500 has Microsoft at 6.95%, Apple at 6.92%, and Nvidia at 6.11% of the index. Other ETFs can have top holdings with even higher weightings such as 15%. So make sure you understand what individual stocks actually make up what you are holding. After all, you wouldn't want a company you think will perform poorly secretly making up a big part of your portfolio. Speaking of parts of your portfolio, it is also important to know the weighting of your ETFs so that you can avoid what is called overlap, where you become over-concentrated by holding more similar companies and industries than you realize. For example, the S&P 500 already has a high weighting on tech stocks. If your only other holding is another technology-concentrated index like the Nasdaq, there likely isn't enough diversification. So, if tech performs poorly for a year, your portfolio would crumble. There's nothing wrong with some overlap, just make sure your holdings cover a range of sectors and countries. Again, Yahoo Finance is a great way to do this. Just search up the ETF and then click the Holdings tab, where it will show the sector weightings percentage. At least Yahoo's still good at something right.
Try it out, kid. Yahoo.
For individual stocks, this step involves a much deeper dive into researching companies, understanding their business models, financial health, and growth prospects. First, remember your goal and strategy to outline what types of stocks you are looking for. Is it growth potential, dividend yield for extra income, companies in certain industries or countries you think will do well? For beginners, it is best to start with large, established profitable companies. These could be companies you are familiar with and use regularly. A great place to start researching individual stocks is by reading the company's website to learn about its business model and searching for articles on both positive and negative cases for the stock. From there, it is imperative to review the company's financial health. The balance sheet, income statement, and cash flow statement will be your best friends. The balance sheet shows what the company owns versus owes, the income statement shows how much money the company makes, and the cash flow statement shows how it manages its cash. You will want to familiarize yourself with how to read these financials. With a quick tutorial and practice, you should have everything you need to grasp the basics. From there, going more in depth, there are the company's quarterly reports, found on the company's investor relations website. Key metrics will include earnings, revenue growth, and the management strategy and expectations. Is the company increasing their sales year after year? Are they becoming more profitable? These clues can give you insights into a company's health and potential. Also, consider the company's competitive position in its industry. Do they have a unique competitive advantage or a strong brand? I know, it's a lot to take in, right? That's why ETFs are usually best for beginners. But it is still important to have an understanding of individual stocks as they are what make up ETFs. Finally, for individual stocks, before you buy, the last step is looking at the company's valuation. As Warren Buffett puts it, the stock price is what you pay, and the valuation is what it is worth. You can use what's called the PE or price-to-earnings ratio, which as it sounds compares the price of a stock to its earnings. Compare the PE to the company's historical average and to other companies in the industry to get an idea of whether it is more or less expensive. There are many other in-depth ways to value a stock, including a discounted cash flow model. Let me know in the comments if you would like a detailed video on valuation. Overall, it's almost like assembling a fantasy football team. You select players based on consistent strong performance, potential for growth, and contribution to the team's overall strategy. Don't worry though, strong companies will be much more consistent and less injury-prone.
I need your help with my fantasy football.
All in all, good research helps you make informed decisions and increases your chances of picking winning stocks. Step number 7. Choosing a brokerage. This is just an app or website where you'll buy and hold your stocks. I'll have links to each of the best brokerages depending on your country in the description, attached with the highest sign-up bonus to maximize the start of your investing journey. In the US, Schwab, Fidelity, Robinhood, and SoFi are great options. In Canada, Wealthsimple is pretty much the only option with no fees. Overall, when picking a brokerage, you should ensure they charge no fees for buying stocks, are user-friendly, and have the investment options to suit your needs. Another great feature is looking for a brokerage with split shares, which basically means you can invest in a company with any amount of money, as little money as you want. A quick Google search to compare brokerages on sites such as NerdWallet is really all you need to do. Once you have your brokerage, consider using a tax-free account like a Roth IRA in the US and a TFSA in Canada. These tax-advantaged accounts will help you tremendously in the long run. Each country has different options and rules, so take note to research that later. Step number 8. When to buy.
Buy low, sell high. That's not what you're gonna...
Now that you are up and going, consistency is key. Instead of trying to time the market, it is almost always best to focus on investing regularly. This strategy is known as dollar-cost averaging. It's like catching waves at the beach. Instead of trying to wait for the perfect splash, you'll perform better by paddling out regularly and riding whatever waves come your way. After all, if you're always trying to time it, you could choose the wrong wave or miss it completely. Adding to the strategy, you can buy more heavily when the market is down and a little less when it's on a hot streak. Say you plan to invest $100 a month. During dips, you can invest $120, and during high periods, reduce it to $80. This way, overall, you will have a lower average cost, meaning you will have more gains long-term. It can also help reduce the impact of market volatility and take negative emotions out of investing. Dollar-cost averaging works for both ETFs and individual stocks. Be careful though, while ETFs that track the market as a whole almost always go up over time, individual companies can fall and never recover. Finally, you can also set up automatic contributions to your investment account, whether it's monthly, bi-weekly, or whatever works for you. However you do it, as you practice, you will start to get the hang of it. The key is to stay consistent and keep adding to your investments over time. Step number 9. When to sell.
Get back in there at once and sell!
Think of your investments as a fine wine collection. While nice to pop open a drink, it can often lead to regret, as that bottle's value will likely increase significantly over time. Just as wine matures and improves with age, so will your investments if you let them be. Buying and holding has been proven the most effective strategy over time. That being said, there are still a few key times when you might consider selling. An obvious one is if you need the money. Say you've had some great gains over 5 years and now can put it into a house. The next reason is if you see a better opportunity to invest in a different stock. Be careful though, this may lead you to start chasing returns. Statistically, the more you trade, the worse your returns get on average. The last reason is if that wine has turned to vinegar, as in the business is no longer the same and deteriorated significantly. ETFs will rebalance and eventually kick out failing companies for you. So you only really need to worry about this for individual stocks. Overall, the most important thing is to limit losing money and give your investments time to grow. Step number 10. Always keep learning. Statistically, we are in a bull market 80% of the time. That means stocks are going up consistently, so often people fall for the trap of thinking they know everything. This overconfidence can lead to risky decisions in trying to chase the short-term hype. Never buy a stock because a YouTuber or someone else on the internet told you to. The internet is a great place to get ideas, but always do your own due diligence. Remember, the stock market is a long game, and it requires patience and discipline to succeed. Investing is a tool to build wealth over time, not overnight. Think of planting a tree. You don't expect it to immediately grow into a towering oak. It takes time, nurturing, and sometimes weathering storms. But if you prepare yourself emotionally, stay patient, and keep nurturing it, your tree will grow strong and provide shade and fruit for years to come. So, keep watching videos, reading, and consistently learning, and you'll become a better investor each and every day. There you have it. Congratulations on starting your journey. By understanding the stock market, setting clear goals, building your portfolio, researching thoroughly, choosing the right brokerage, investing regularly, and always looking to learn, you are well on your way to becoming a successful investor. Remember, every great investor started somewhere, and today, you've taken your first step. Your financial future is in your hands, and the sky's the limit. I hope you learned some valuable knowledge today to take on your investing journey and goals toward financial freedom. Leave a comment below with your biggest takeaway or any questions you have, and I'll be sure to answer you. If you've enjoyed, subscribe to your future and leave a like rating. You'll get the latest insights and tips straight to you, helping you stay ahead in your investing journey. Let's build a brighter financial future together, one step at a time. See you in the next video.
Awesome, dude. You're awesome.